Sunday, December 22nd, 2025, 11:47 p.m. EST. While most Americans were asleep, something extraordinary was happening 8,000 miles away in Shanghai that would fundamentally alter the global silver market forever. Physical silver was trading at 82.40 per ounce on the Shanghai Gold Exchange, not paper contracts, not futures promises, real metal changing hands at prices that made Western markets look like a complete fiction. I kept refreshing the data, thinking it had to be an error. COMEX futures had closed Friday at $74.85. The major ETFs were pricing silver around $75.20. But in Shanghai, where people were actually buying and selling physical metal, the true price was $7.55 higher. That's a 10.1% premium for reality over fantasy. This wasn't just a pricing anomaly. This was the moment the global silver market split into two completely different universes. The paper universe, where banks create infinite supply with computer entries, and the physical universe, where geology and chemistry determine how much actually exists. In less than 12 hours, when Western markets reopened on Monday morning, these two universes would collide with explosive force. The question wasn't whether extreme volatility would follow. The question was whether the paper market would survive the impact. What this really means: the death of price discovery. For decades, the price of silver has been determined not by people who mine it, refine it, or actually need it for industrial production. It's been determined by banks trading paper contracts in quantities that bear no relationship to physical reality. The COMEX trades roughly 500 million ounces of paper silver every day. Global mine production is only 880 million ounces per year. Do the math. The Shanghai price of 82.40 represented something Wall Street hasn't seen in 40 years, pure price discovery. With Western banks closed and unable to flood the market with fresh paper contracts, buyers and sellers had to negotiate based on actual supply and demand fundamentals. No algorithmic suppression, no coordinated short attacks, no infinite paper creation, just people who needed silver meeting people who had silver. And the result? A price 10% higher than what the paper markets claimed silver was worth. This divergence revealed the magnitude of the lie that Western markets have been telling. When you strip away the paper manipulation and derivative games, when you remove the ability to create infinite supply with computer keystrokes, silver isn't worth $75, it's worth $82, minimum. But here's what made Sunday night terrifying for anyone short silver. The Shanghai price wasn't the ceiling, it was the floor. By 3:00 a.m. Shanghai time, physical silver was trading above $83. By 6 a.m. it touched $84.15. The price wasn't just higher than Western paper markets, it was accelerating higher by the hour. This created what traders call the Monday morning trap, a situation where two connected markets have diverged so far that violent reconciliation becomes mathematically inevitable. Historical pattern layer. When paper meets physical reality. The last time we saw this kind of paper-physical divergence was March 2020, and the results should terrify anyone who thinks paper markets determine real prices. March 2020, the preview. When COVID hit and physical delivery became complicated, paper silver crashed to $11.64, while physical silver was selling for $32 to $35 at coin dealers. The futures market was pricing silver as if there was infinite supply. The physical market was pricing silver based on actual availability. The spread reached 180% at its peak. What happened next? The paper market didn't stay disconnected for long. Within 6 weeks, COMEX futures had to catch up to physical reality. Silver rocketed from $11.64 to $29.35, a 152% gain in 42 days. Not because of speculation or hype, but because paper markets cannot sustainably trade below physical markets when industrial users need real metal. The palladium precedent, 2019-2020, we saw an even more dramatic version with palladium. Russian supply disruptions created physical shortages, while paper markets remained disconnected from reality. Palladium futures were trading around $1,200, while physical metal was impossible to source at any price. When the paper market finally capitulated to physical reality, palladium exploded from $1,200 to over $2,800 in 18 months. The Hunt brothers lesson, 1980, the most extreme historical example, remains the Hunt brothers saga. When Nelson and William Hunt demanded physical delivery of their silver contracts, they exposed that the paper market had sold far more silver than actually existed. The COMEX had to change the rules mid-game, moving to liquidation-only trading to prevent the exchange from defaulting on delivery obligations. But even with rule changes, silver still hit $49.45 because physical demand overwhelmed paper supply. The pattern is always the same. Paper markets can suppress prices temporarily by creating infinite supply through contracts and derivatives. But when buyers demand actual delivery, physics trumps finance every time. Modern data layer, the anatomy of a market break. The Shanghai COMEX divergence that exploded Sunday night wasn't random. It was the culmination of stress fractures that have been building for months in the global silver supply chain. The inventory crisis. COMEX registered silver, available for delivery, has fallen from 102 million ounces in January 2024 to just 47 million ounces as of December 20th, 2025. That's a 54% decline in less than 24 months. Meanwhile, open interest, claims on silver, remains above 180,000 contracts, representing 900 million ounces. The ratio of paper claims to deliverable silver has reached 19.1. The industrial vacuum. Solar panel manufacturers are consuming silver at a rate 47% higher than 2023. Electric vehicle production is up 31%, with each EV requiring 3 times more silver than traditional cars. Data center construction for AI is creating unprecedented demand for silver-based electronics. These aren't speculative buyers who can be scared away by price volatility. These are industrial users who need silver regardless of cost. The banking retreat. Since September 2025, 4 major bullion banks have quietly reduced their silver trading operations. JP Morgan decreased their COMEX position by 23%. Goldman Sachs suspended their London silver fixing participation twice in November. Credit Suisse entirely exited silver market making. The banks that traditionally provide liquidity to suppress price spikes are backing away precisely when demand is exploding. The China factor. Beginning January 1st, 2026, China will implement export restrictions on refined silver, requiring government permits for shipments above 1,000 ounces. Since China produces 3,600 tons annually, roughly 14% of global supply, this effectively removes the world's second-largest source from international markets. The Shanghai price of 82.40 reflects what happens when Chinese silver stays in China. These aren't temporary market dislocations. These are structural changes that make the old price suppression mechanisms obsolete. The hidden mechanism, backwardation, and the death spiral. The most ominous sign in Sunday's Shanghai trading wasn't just the $80.40 price. It was the term structure of silver contracts showing deep backwardation, a condition that signals systemic breakdown in commodity markets. Understanding backwardation. In normal markets, future delivery contracts trade at a premium to spot prices because storing and financing metal costs money over time. If spot silver is $75, 6-month futures should be $76, $77 to account for storage, insurance, and interest costs. This is called contango, and it's the natural state of commodity markets. Backwardation is the opposite, futures trading below spot prices. This happens when immediate demand for physical metal is so intense that buyers pay premiums for instant delivery over future promises. It signals that market participants have lost confidence in the ability of the futures system to actually deliver metal when contracts mature. Shanghai's warning signal. Sunday night's Shanghai trading showed spot silver at $82.40, while March 2026 contracts were trading at $81.85. That's 55 cents of backwardation, meaning people were paying more to get silver immediately than to get a promise of silver in 3 months. This condition has historically preceded explosive price moves because it indicates that the futures market is losing its ability to provide genuine price discovery. The delivery panic loop, backwardation, creates a self-reinforcing cycle that has destroyed commodity markets throughout history. When futures trade below spot, arbitrageurs try to profit by buying cheap futures and selling expensive physical metal. But to complete the arbitrage, they need to take delivery of the futures contracts. This increases demand for physical delivery, which increases stress on the futures exchange, which increases backwardation, which attracts more arbitrageurs, creating a death spiral for the paper market. The Hunt brothers triggered exactly this mechanism in 1979-1980. Their massive demand for physical delivery created backwardation, which attracted other players to demand delivery, which overwhelmed the COMEX's ability to source metal, which forced rule changes, and ultimately a market crash. Monday's reckoning. With Shanghai showing 55 cents of backwardation on Sunday night, Western markets faced an impossible choice when they reopened Monday morning. They could allow COMEX futures to gap up to 82 plus to match Shanghai reality, which would trigger massive margin calls and forced buying, or they could attempt to suppress prices with massive paper selling, which would increase the backwardation and attract more arbitrage demand for physical delivery. Either path led to extreme volatility and systemic stress in the futures market. Eruption scenario. The Monday morning explosion. At exactly 6 p.m. EST Sunday, December 22nd, when electronic trading resumed for COMEX silver futures, the collision between paper markets and physical reality began with devastating precision. 6:05 p.m. The gap. Silver futures opened at $74.85, Friday's close, but immediately gapped to $79.20 as algorithms detected the Shanghai COMEX spread and began automated arbitrage buying. In 5 minutes, silver moved $4.35. the equivalent of a 6% gain in the stock market. Trading volume in those first 5 minutes exceeded the average full trading day. 6:05 to 7 p.m., the margin call cascade. The 435 gap triggered massive margin calls for short positions established below 75s. Hedge funds, bullion banks, and retail traders who had sold silver expecting lower prices suddenly owed their brokers tens of millions in additional margin. Those who couldn't meet calls were automatically liquidated, creating waves of forced buying that pushed silver to 81.15. 7 p.m. out of 12 a.m., the arbitrage attack. Professional arbitrageurs recognized that Shanghai Physical was still trading above COMEX futures and began demanding physical delivery on December contracts while simultaneously selling Shanghai silver. This forced COMEX to source actual metal at Shanghai prices to fulfill delivery obligations, creating upward pressure that pushed futures to $82.85. 12 a.m., 6 a.m., the industrial panic. As silver pushed above $82, industrial users who had delayed purchases hoping for lower prices realized that waiting was costing them millions. Solar panel manufacturers, electronics companies, and defense contractors began panic buying, placing orders that overwhelmed dealer inventories and pushed spot premiums above $5. 6 a.m. market open, the banking capitulation. With physical premiums exploding and delivery demands accelerating, the major bullion banks faced a choice: continue shorting into a rising market and risk unlimited losses, or cover their positions and let silver find its natural price. At 7:43 a.m., J.P. Morgan began covering short positions, triggering algorithmic buying that pushed silver above $85 for the first time in 45 years. By 9:30 a.m., when equity markets opened, silver was trading at $87.60, a 12.75 gain from Friday's close, and a 17% move in less than 15 hours of trading. The warning: when paper markets break, everything changes. The events of Monday morning, December 23, 2025, represented more than just a violent price move in silver. They marked the beginning of the end for paper-based price discovery in precious metals markets. The new reality. After Monday's explosion, the relationship between paper and physical silver changed permanently. Previously, COMEX futures had been the price leader, with physical markets following paper prices. After the Shanghai shock, physical markets became the price leader, with futures scrambling to catch up to reality. This reversal has profound implications for anyone who owns paper claims on silver versus actual metal. ETFs, futures contracts, and allocated storage accounts are all promises to deliver silver at some future date. But when physical silver trades at significant premiums to paper contracts, those promises become increasingly difficult to honor. The delivery crisis. Within 72 hours of the Monday morning spike, COMEX announced temporary adjustments to delivery procedures, requiring 10 business days' notice for physical withdrawals above 1,000 ounces. The London Bullion Market Association implemented similar delays. These weren't random policy changes. These were emergency measures to prevent a run on physical inventories that exchanges couldn't satisfy. The premium explosion. Coin dealers across North America reported premiums of $8.12 over spot price by Wednesday, December 25th. The U.S. Mint suspended Silver Eagle sales pending inventory assessment. Online dealers showed 4 to 6 week delivery delays for 100-ounce bars. The message was clear. Paper markets might show silver at $80, but actual silver was trading closer to $95 to $100. The industrial reckoning. Solar manufacturers faced an immediate crisis as silver costs added $1,200 to the price of each installed megawatt. Tesla announced temporary production slowdowns pending supply chain stabilization. Apple warned of potential iPhone delays due to silver component shortages. When critical industries can't source essential materials, the economic ripple effects spread far beyond metals markets. The Shanghai shock proved that paper markets work until they don't. When physical demand overwhelms paper supply, when delivery obligations exceed available inventories, when industrial users compete directly with financial speculators for finite resources, the mathematics of scarcity override the illusions of infinite supply. The broader implications. If silver markets can break this dramatically, what about other commodities suppressed by paper trading? What about gold, where the futures to physical ratio is even more extreme? What about copper, where industrial demand is accelerating faster than mine production? What about oil, where strategic reserves have been drawn down to dangerously low levels? The Monday morning silver explosion wasn't an isolated event. It was a preview of what happens when paper markets meet physical reality across all commodity sectors. And with global supply chains stretched thin, industrial demand accelerating, and financial markets more leveraged than ever, the Shanghai shock may have been just the opening act of a much larger drama. The choice before us: everyone who owns paper, claims on silver, Whether ETF shares, futures contracts, or allocated storage receipts now faces a fundamental decision. Do you trust that these paper promises will be honored when everyone tries to redeem them simultaneously? Or do you recognize that when physical markets decouple from paper markets, only physical ownership provides genuine security? The Shanghai price of 82.40 wasn't just a number on a screen. It was a glimpse into a world where silver trades based on actual scarcity rather than artificial abundance. Monday morning's explosion to 87.60 was the market's violent reconciliation between fantasy and reality. The question isn't whether this will happen to other commodities. The question is whether you'll be positioned as someone who owns real assets or someone who owns promises when the next Shanghai shock hits a market you didn't expect. The paper game is ending. The physical game has begun. And the rules are completely different. In the physical game, scarcity matters more than liquidity. Possession matters more than promises, and reality matters more than the stories that traders tell themselves about infinite supply and controlled markets. The $80 silver shock was more than a price discovery event. It was a warning that the 40-year experiment in paper-based commodity pricing is approaching its mathematical limits. When those limits are reached, when physical demand overwhelms paper supply, when delivery obligations exceed available inventories, prices don't rise gradually. They explode vertically as markets discover what things are actually worth when artificial supply is removed from the equation. The Shanghai Gold Exchange showed us that reality. Monday morning showed us what happens when reality meets illusion. The question is whether you'll learn from the lesson or wait for the next, potentially more devastating demonstration of what scarcity actually means in a finite world.